You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Welcome, everybody. This is Buck Joffrey with the Wealth Formula Podcast coming to you from Montecito, California. And today, before we begin, a couple things I want to remind you of. First of all, there is a website associated with this podcast, wealthformula.com. Lots of different resources there for you, so check that out. And also, it's where you go to sign up for various lists, like the Accredited Investor Club. That is a club that if you are an accredited investor, you ought to consider so that you can potentially get some deal flow to consider. There's some really interesting stuff that we're doing this year. We've traditionally been into the real estate space, but gosh, we've got some cool aviation stuff. You know that we've got the whole ATM thing going all the time. And also we're going to be doing some mergers and acquisitions, all that kind of stuff. And pretty neat. By the way, this aviation thing just got even cooler for those of you who are interested. It's basically targeting at least 100% depreciation on the investment. So that's right, at least 100% depreciation for investors. So if you are looking for a depreciation type investment, that is something you're going to want to check out. Also, I want to let you know that this course that I had created, this course, for personal finance, I think it was like 2018, your roadmap to real wealth. We're now giving that away. Okay, so if you have not done that, and I'm trying to figure out, and I know it's available at wealthformulabanking.com, so you could grab it there if you want. This is a course that, it actually cost quite a bit of money to put together, but, it is what it is at this point. I just want to make sure that anybody who wants that information has it. You can get that at wealthformulabanking.com. And feel free to, send it out also to your friends and family, because there's a ton of really good information on there. I mean, it's really just, it's got guys like Tom Wheelwright there talking about taxes. You've got a huge amount of information on asset protection and estate planning, and like we had Kenny McElroy's on there talking about real estate. It's a good course, and it is for free, so you can't beat the price. Check that out, wealthformulabanking.com, and there's probably somewhere else where it's sitting too. It might be at wealthformularoadmap.com too. Shows you how much I know, but at any rate, if you want it for free, definitely go to wealthformulabanking.com, because I'm putting it on that site as a free thing to give away too. So, okay. So for today, let's talk a little bit about, where I'm at, and where, things happen in life where you're transitioning. I feel like I'm at another major transition in my life. I turned 50 last September. This is a fact that I deliberately chose not to publicize. It's not something I'm really fond of people knowing about. In fact, I would say that, I'm working on my lying skills about that. I'm just going to be 49 for a while. But anyway, I hate to admit it, but much of my behavior at this point is pretty stereotypical of a guy who's sort of in who's divorced and midlife crisis stuff. I got a Ferrari. I didn't tell you that either. I did get a Ferrari, the one I've been wanting for years and years and years. And maybe it wasn't the best time for me because it's not been a couple of good years for me, but I've wanted this. When am I going to get it? Right? When am I going to get it? Just turned 50. No one's given me a Ferrari, so I got it for myself for my birthday. Anyway, super cool. I've been working out incessantly. And actually, I currently bench press as much as I did, if not a little bit more than I did in high school, which is something I never thought I would be doing at 50. And as another part of my midlife crisis, yes, I have been considering adding publicly traded equities to my portfolio. Okay, the last one might seem like a little bit of a surprise to you, maybe a big surprise to you. For the last decade, Wealth Formula Podcast has consistently and systematically bashed the stock market. So what changed, Buck? Well, you see, the last 2 years, again, have not been particularly kind to me financially. And it's been because I'm about 80% real estate in my investment portfolio. Now, rising interest rates, as we had in the last, 24 months or so, disproportionately affects the real estate markets because they are so heavily dependent on debt. That's why, despite the fact that economists keep talking about how the economy itself continues to, thrive and do well, us real estate investors feel like it's 2009 because what we do is so dependent on interest rates. It seems like there's a completely different narrative going on about the economy. Now, listen, don't get me wrong. I'm not leaving the whole real estate thing. In fact, down markets is when you really, again, you have an opportunity to potentially make a lot of money if you are not scared away and, kind of decide you don't want the volatility and all that stuff. I mean, people did it again in 2009 and then boom, and people made tons and tons of money in the next 15 years. And there's a little setback and then people get freaked out. It's like that whole Warren Buffett thing about, buying when others are scared and so on and so forth. I mean, that's what you got to do. But listen, again, when it comes to real estate, I'm saying I didn't have a couple of good years here, like I know a lot of people haven't, but don't get me wrong. I am not going full on stocks, bonds, and mutual funds. I have made my money in real estate over the last, 15 years or so. And I recognize that is my alpha, right? That drives me crazy. It reminds me of, those of you who watch football, does this drive you crazy? Like when you see your team like kicking butt in the first half, right? You see your team kicking butt and you're like, man, they're doing great. They're like, they're passing the ball, they're moving the ball down, and all of a sudden they get ahead, right? And then they just, it's like the second half comes and all of a sudden they change their game plan. They completely changed their game plan. And instead of being up by 20, now they're just for some reason sitting around and waiting for the other team to play catch up because they've decided they want to go into defensive mode. Why would you do that, right? Why would you leave the thing that got you there in the first place? Well, that's my point. I am not leaving real estate. Despite this down market, there's no doubt I'm way ahead where I'd be, compared to, if I was just a traditional investor, having used a money manager in the last 15 years. No doubt about it. Real estate, there's no doubt, has made me wealthy by a number of metrics over the last 15 years, despite this recent hiccup. So what is this crazy talk about stocks that I'm just bringing up? Well, you see, I'm just thinking about taking some lessons from the institutional professional investors out there. Perhaps it's that middle age of mine, but the idea of a more balanced, possibly less volatile portfolio is sounding, kind of appealing. I mean, geez, the S&P 500 is up 25% right now. And meanwhile, a lot of real estate's down 25, 30%, right? So maybe it makes sense to have a little bit of balance. Right now, I'm not balanced, man. I have zero exposure to publicly traded stocks. Zero. And maybe that number, though, should be closer to 20, 25%, right? Maybe that should. I mean, it doesn't mean I have to change completely. Maybe I should be in some kind of quote unquote all-weather portfolio to decrease some volatility in some portion of my portfolio, right? After all, I mean, I do, 5 to 10%. It was 5. Now it's like 10% of my, money is like cryptocurrency, right? I mean, so why not, why not have some other types of balance as well? Remember, again, before you think I'm starting to lose it, personal finance should be personal. So these things got to be fluid. They got to be dynamic. You've got to think about your own goals and where you are in life. You have to treat your investment portfolio like you're deploying money for your own family office. It's a business. And you have to think about, where's your business? Are you in massive growth mode where you're like all alpha all the time? Or are you like, gosh, I wish I'd just kind of put the brakes on a little bit, maybe hedged a little bit, that kind of thing. And that's all I'm talking about. I have a lot of these conversations with Zulfe Ali. Now, a lot of you know him. He is a guy with, a pretty significant institutional pedigree. He knows a lot about risk and managing portfolios. He does that for family offices and high net worth individuals like you and also, people who are maybe ultra high net worth as well. Although there are some of you out there I know who are ultra high net worth. I don't know what that number actually means, but when I think of ultra high net worth, I'm defining that as sort of like, having a maybe a at least a $20 million portfolio, like a net worth. That's what I'm thinking of, ultra high net worth. Anyway, he has a number of those people. He's managing their money. He's different from your usual financial advisor because he recognizes the importance of alternative assets in a portfolio, and that's why I like what he does. It's something he learned from running a multi-billion-dollar sovereign wealth fund in the Middle East. I mean, people, this is smart money. Anyway, on this week's episode of Wealth Formula Podcast, Zulfe and I talk, and he is, he's going to tell us a little bit about those strategies he learned, but also he's going to give his take on the current economy. So you definitely want to tune in. Having a guy with, his credentials, giving us an update is definitely valuable. So make sure to tune in, and we'll have that interview right after these messages. Welcome back to the show, everyone. Today, my guest on Wealth Formula Podcast is Zulfe Ali. He's been on before. He's a former investment banker. He's worked in global banks such as J.P. Morgan and Bank of America. He's been involved for decades in IPOs, mergers and acquisitions, leverage buyouts across the U.S., Europe, and the Middle East. He has also served previously as a chief investment officer of a sovereign wealth fund in the Middle East, where he oversaw the global investment strategy of a $14 billion portfolio of assets. He has since moved on to the retail side. So now he is looking at helping people like us, people who are individuals, to grow their worth, and leads two businesses, specifically one called Ferrari Group, which is a broker-dealer focused on private placement offerings, which we've worked with in our group, and Ferrari Wealth, which is a registered investment advisor that provides financial planning and investment advice to accredited investors and family offices. Given his experience and current focus, he's obviously got a deep knowledge of global financial markets and a well-tuned perspective of the current investment landscape. Zulfe, welcome back to the show.
Hey, thanks, Buck. Good to be back. Good to see you again.
Let's just jump right into it. It's been a while since we've really kind of like talked about what's going on in the economy. It's been a wild ride the last 24 months or so. What's going on right now?
Yeah, I mean, actually, the economy has been pretty steady, right? So there's a lot of volatility we've seen, whether it's the financial markets, maybe, data, maybe different asset classes. But in all, respects, it seems like the economy has just been kind of a steady growth story. We've continued to have GDP growth ranging anywhere from 1.5% to 3%. It's still the consumer that keeps driving this. So we've got, a consumer that has good employment. So the unemployment rate is really low. It's a tight labor market. Wages are increasing, so they continue to grow 5 to 7% annualized over the last several years. There's been a little bit of drawdown from personal savings. So, people are starting to dip into savings, maybe not saving as much. There's a bit more usage of credit by consumers. So we understand, like, for example, credit card balances are up by about 10% from a year ago. That is all, kind of helping the consumer with their spending, which is adding to the economy. And so the economy is doing really well, and the conditions are probably sustainable for another 12 to 24 months. And then on the corporate side, it's the same thing. We've got just another a quarter of earnings that companies have been reporting. Yeah, it's a little mixed here and there, but by and large, strong earnings. Companies are operating in a favorable environment. S&P is up 25% since last year. So the stock markets are appreciating all of that. All this talk about a recession that we were supposed to see on the back of a Fed tightening cycle, which saw the Fed rates go from 0 to 5.25. That recession, we're still waiting for it. And even as we sit here today, it's unclear if the recession is coming, if we're just in a pause before a reacceleration. But overall, pretty steady in that respect.
How is it possible that you go from 0 to over 5% interest rates and not have a recession? It just seems like, from the corporate side and lending, the credit markets and all that. How is it possible? I mean, what do you think has driven this thing the way it has?
It all goes back to the consumer. So if you think about what accompanied the same time frame as the rate cycle was going up, that was on the back of a tremendous windfall for individuals
and businesses, by the way, because you had the PPP loans. You had an enormous amount of money coming in. Every business owner I know, including myself, got money even if they didn't need it. Yeah,
you saw that, and then the other piece of it, I think, just as important, and we've seen elements of this play out, is that the financial sector, and particularly the banks that should have been hit the hardest with that surprise rate of increase of rates. Well, some of them did get in trouble, and what ended up happening was
they got bailed out.
They effectively got bailed out. So the stuff that could have been ugly has been contained from government stepping in. And and then in the meanwhile, both the consumer and corporates, as you mentioned, have had really nice balance sheets because of all the windfall cash coming in. So that has been a tremendous buffer to the rates spiking the way they have.
And I guess that explains the job market too. If you've got businesses that have got really padded balance sheets, they're not as afraid to spend and continue to grow, despite the potential warnings that we've had for recession. They've not necessarily responded to those, right?
Yeah, no, that's true. I think, and then where you have seen, situations where companies are laying off folks, here and there, those individuals have several offers to join different firms. So you're not seeing this fear on the part of individuals that if they leave a job that they won't get a job. And in fact, it's just the opposite. People are still pretty confident that they will remain employed whether they stay with their current employer or not.
The stock market and all that is going up, but real estate is obviously being so heavily dependent on debt, interest rates, and all that has been pretty significantly affected. You even mentioned sort of the regional banks being affected by probably significant problems in the commercial real estate sector. And a lot of that is rate driven. And I think we're going to continue to probably see, sort of this lack of liquidity and all that in that space until, the rates stabilize or clearly are stabilized or are dropping. So when you look at interest rate outlook, at least in terms of like what the Fed is signaling and all that, what are you seeing?
So the Fed has signaled that they are likely at the peak of their tightening policy. So they've actually stated that, this is probably as high as they go. Barring any unforeseen changes, in terms of the economy, in terms of inflation, what have you. What the Fed chairman has been recently saying is that they're gonna stay at this rate until they see the data that shows the expected softening of economic conditions. They still do have from a position from their side that they expect the conditions to soften, economic conditions to soften later in the year. But that there is uncertainty about that, and it could be that it doesn't soften, significantly, the economy. So, I think if you think of what the Fed's doing, they've pretty much got the economy on kind of cruise control. They've got their brakes they've got their foot kind of hovering over the brake pedal. When they see that data that shows that the economy is gonna soften, then they can pull the trigger. But I don't think they have any incentive to do that now, because again, the unemployment is low, so you've got a full employment situation, and inflation is still a little higher than they want. Inflation targets of 2% have not been met, so inflation is still north of 3% at this point. So they're not going to act anytime soon. I think what'll be interesting is if we start seeing some pressure, particularly as we're heading into an election cycle here. There'll be some interesting conversations or maybe communications from various individuals putting pressure on the Fed. But I doubt that I doubt that the Fed will be acting one way or another based on that.
As we talk about interest rates, one of the things that real estate investors get a little confused about, and maybe we can just kind of do a quick 101 on this, is the idea or the connection between the different interest rates, which is the Fed rates, versus maybe sort of the 10-year Treasury versus SOFR. A lot of real estate debt now is based on SOFR or 10-year Treasury. So what can you kind of give us sort of a review of that?
Yeah. I mean, obviously, I think everyone pays a lot of attention to the Fed funds rate, right? So that is set by the FOMC. That's the interest rate at which the commercial banks are lending money to each other on an overnight basis. So when the Fed sets that rate, that effectively becomes a short-term borrowing cost for commercial banks. And depending if that's high, then they're going to charge higher interest rates to customers, whether it's to mortgage or to the credit card, whatever. And when it's low, consumers and corporates will benefit. So so the Fed rate is set, and that's set to stimulate either the contraction or the expansion of borrowing activity, which then impacts the economic growth. SOFR, which is the secured overnight financing rate. There used to be LIBOR, but now SOFR is the kind of rate that is widely used, particularly in the U.S. It's actually not set by the Fed or any financial regulatory body like that. It is actually a measure of the overnight rate for risk-free lending in U.S. dollars. So it's collateralized loans, collateralized by U.S. Treasuries, in fact. And again, basically the commercial banks are borrowing these in overnight situations for their own reserve requirements. So
it's pretty. It follows. It's sort of like kind of similar to tracking the 10-year Treasury, though. I mean, no.
It's actually more similar to the Fed funds rate in terms of where it's at. So if you think about it, they're both overnight rates.
Right.
The Fed is basically setting the benchmark, the Fed funds rate.
Right.
SOFR actually will be very, very close to the Fed funds rate. Typically, just a couple of basis points,
Right.
away from it. Now, the Treasury is effectively correlated, but not necessarily linked to SOFR. So think of SOFR as a very short-term overnight rate, very similar and kind of linked to the Fed funds rate. And then the 10-year Treasury is really just the market trading level of a Treasury that's a 10-year maturity, and so that's purely driven on future expectation of interest rates.
Right. So in a way, though, because the 10-year Treasury is in real time, pretty much, it's changing all the time. So that's sort of like kind of a what people think's going to happen with rates. So
Exactly.
it's right. Like so, if there's an anticipation that the Fed's going to raise rates, I mean the Treasury's going to go. The Treasury's going to go up, right?
Maybe. So for example, if the Fed starts raising rates super high, the expectation is going to be that they're going to diminish the prospects of growth for the economy, and therefore in the future they're going to have to lower those rates, and the treasuries might actually go lower. And so you can have this situation where you've got an inverted curve where the near term is higher than the far out term, right? The way to think.
Talk about the inverted curve, by the way, because that comes up a lot. And maybe you can sort of emphasize that, and I think there would the correlation between that and recessions is high, right?
It's been typically high because again the curve is basically a measure of the different rates along the different maturities of treasuries. So everything from 1 year, 2 year, 5 year, 10 year. So the curve is basically going along that axis. And if short-term rates, let's say the 2 year is at 5%, and at the longer end at 10 year, let's say it's at 4%, it's inverted, meaning you're actually going from a higher to a lower interest rate. And so that typically, what that is signaling is that the markets believe that the economy is going to slow, and it could be a recession, it could be just a slowdown, but it's basically saying that there's going to be a point where the current higher rates are going to have an impact on the economy and bring the economic growth down, and therefore the Fed will probably also have to decrease their Fed rates so that when you get to that point in the future, you're going to have a much lower Fed rate at that point as well. So that's kind of where we've been at for a while. So, has just been sitting there thinking, okay, recession, but there's been no recession.
Isn't it like it has never not been the case or something like that with an inverted curve?
It's not been that. It's not been 100% predictor, but it's been a pretty reliable predictor. So it's not 100%.
Let's move on a little bit. Public equities, you mentioned S&P up 25% year over year. I guess the question there is, based on where things are at, are we at a peak? There was, and curiously, there was, a bunch of reports about large sales from, these CEOs that typically don't sell their stock, like Jeff Bezos sold a ton of Amazon stock. Jamie Dimon's sold a bunch of, JP Morgan Chase stock, and he's known to never sell anything. But they're selling a huge amount. What do you think's going on?
I think first of all, the market is at a pretty amazing level, and I think it's your guess as good as mine in terms of if we're at a peak. I get the feeling that there's still a little bit of room here for further, increases in the market, just because, there's the environment is still pretty attractive, right? You've got, in particular on the equity side, I think there's a lot of market sentiment that equities are a safe place to be, because if you think about it, if the economy continues to grow and earnings are strong, then you've got support for equity prices continuing to rally. On the flip side, if the economy slows and the Fed cuts rates, well, now you've got another reason to own the asset, because the discount rate has just gotten lower, and you can again justify a higher valuation for equity. So I think the equity markets in particular are kind of in a win-win type of a mindset. Now, whether it plays out that way, anyone's guess. And you can contrast that to the fixed income market, right? So if the economic conditions stay very robust, inflation doesn't come down, Fed doesn't cut rates, well, the fixed income market's going to stay kind of choppy and maybe not as attractive. So from that respect, equities kind of are covered both ways. In terms of selling, insider sales, it's probably Bezos has left Amazon a while ago. He's probably selling to build more rocket ships or whatever. It's hard. You don't want to look at one or two individuals. Obviously, both of those guys still have a very large portion of their respective wealth in the companies that they belong to, right? Jamie Dimon and Jeff Bezos still, majority of their wealth is tied up in the stock of their companies. So I wouldn't look at that. But overall, if you look at buy-sell ratio of insider stock activity, we are at a 10-year low.
10-year low meaning people are not selling in general.
There are fewer people buying compared to more people selling. So that does indicate that insiders are doing exactly what Bezos and Dimon are doing, which is they're selling. And I think it is a signal when people that work for these companies are in general kind of taking their chips off the table a little bit in this environment, that I think they're like, okay, we're either fairly valued or maybe even overvalued, and it's time to take a little bit off the table. Particularly because folks have usually a lot relatively large portfolios, and their continued compensation when they work for these companies is more and more stock. So I think selling is typically a good thing, so they can diversify.
Sure. I mean, I guess part of it is if they've made a bunch of money in the last year or two, maybe they want to take some because there is there is a major thing happening this year, which is an election, a presidential election, and it's I mean, it's a pretty interesting one too, in the sense that which way the economy could go with this election. What a fact! I mean, my sense is that, at least from my own experience of going through a few election cycles now, that generally economies tend to slow in election years. Is that accurate?
It's not necessarily supported by data. So I think at the end of the day, it's kind of an even split in election years. If you look at what the stock market typically does, for example, since the S&P index was put into place in the mid 1920s or so, there's been about 23 elections, and 20 of those election years have had positive performance for the S&P. So I think by and large, it shows that the markets kind of look through it, maybe. And I think there's probably very little kind of correlation with respect to which which party's in the presidency versus another. I don't think that's as much. I think what could be interesting this year is that there are some major policy differentiators between the two parties here. So it would be interesting to see how the markets react to another 4 years with Biden, or a switch to Trump and the policies that he wants to bring through. So that, I think we'd have to see how that plays out. But there's not a lot of strong correlation on that.
So, what's interesting to me is a conversation you and I had. I had interviewed that guy that wrote a book about Ray Dalio, and and I asked you the question. I was curious about this because Ray Dalio has effectively not beaten the market he's beaten it like once in the last 20 years, right? And he's this legendary hedge fund advisor, and people are putting in so much, putting in billions of dollars with this guy. And I'm like, how is that? Why do they do that? And what you said to me was kind of interesting, and I didn't really understand it. Maybe you can explain this sort of mentality, from an large investor's perspective.
Yeah, sure. So I think that the none of it is that not all investors, institutional investors, and for that matter, individual investors, not all of them are trying to maximize return.
Yeah, ultra high net worth folks are similar in this. So
yeah, ultra high networks is worth individuals, institutions, the sovereign wealth fund that I worked for. Same thing. The goal was not to maximize returns. The goal was to construct a portfolio that meets various requirements, needs, goals. So that could be looking at what's my liquidity requirements. What are my cash requirements from a cash return perspective? What is my appetite for volatility and risk? And in fact, going back to that same sovereign wealth fund when I worked at, we built a portfolio from scratch, utilizing all of that methodology to say, okay, here's this institution. What are the answers to those questions? Like how much cash do we need? How much do we need to be able to sell very quickly if we need to? How much exposure and volatility can we take in any given year in terms of the portfolio? And when you factor all that in and you build a portfolio addressing those kinds of needs, you almost get it backwards in the sense that then spits out an expected return. So it's not like we go in and we say, okay, we want to get 10% returns. How are we going to do this? It's usually the other way around, where you're saying, okay, I want to protect my portfolio. I don't want much volatility, and that sort of thing. And that's why, someone like Ray Dalio and Bridgewater, the hedge fund that he founded, which has been tremendously successful, they've pioneered different ways to create portfolios that meet the needs of certain investor classes, investor groups, and that sort of thing. So, we've all heard of, I think, the all-weather portfolio that Ray Dalio has talked about before. It's a portfolio that is designed to survive all economic environments. Right, is the way he describe it. So it will perform better than other types of portfolios in certain situations. What he constructed there was a portfolio consisting of stocks, bonds, commodities, and gold. I think those were the four pieces, and there was an asset allocation strategy there with different percentages in each. And what he was able to accomplish by doing that is significantly reduce the volatility of the portfolio. So, one of the metrics that institutional investors in particular, will use for measuring volatility is what's called max drawdown. Max drawdown is basically a measure of a particular asset's largest price drop from peak to trough in a given time. So if you look at the S&P 500 over the last 20 years, the max drawdown was about 50%, meaning from the peak, if you would have invested in the peak, there was a particular peak in that last 20 years where you would have lost 50% all the way down to the trough. And that's a pretty significant max drawdown, right? If you then look at a 60-40 portfolio, which is 60% equities, 40% bonds or fixed income, you can reduce the max drawdown significantly by having bonds because they're less volatile. So in that situation, same 20-year period, your max drawdown is about 27%. So 27% loss if you had allocated at a peak and it went all the way to its biggest trough in that environment. Now with the all-weather portfolio that Ray constructed, that ends up being a max drawdown of about 20%. Which is significant, right? So the person that's sitting in a S&P 500 has taken a 50% loss on his investments, where someone who had put a all-weather portfolio together lost 20% in a max drawdown situation. So that volatility is very big, and that either fits you or it doesn't fit you, right? You want either you are open to more volatility or you are less. Trade-off, course, is your returns.
Yeah.
So whereas your S&P 500 on average returns about 10% over a long period of time, your all-weather portfolio might hit 7%.
Yeah.
So you're going to be giving up a fair amount of expected annualized return for protecting yourself from that kind of volatility. And so that, I think that's a long way of answering, Buck. What are different types of objectives that institutional investors, high net worth investors, what are they trying to solve for? And then the idea then is to try to create a portfolio that helps meet those goals, and maximizing returns or trying to replicate the returns of the stock index or any indices may or may not be part of the objective there.
So I know since you left the Sovereign Wealth Fund, you've got Valerity Wealth, and part of that you have been, you are now managing money for a lot of family offices, ultra high net worth, and accredited investors like people in our group as well. And for those people, certainly. It might be people who are interested in alternative assets like I am. I'm probably too heavy in alternative assets. And there's an argument, for somebody like me to say, well, maybe 25 or 30% of, maybe your portfolio should go into some kind of an all season type thing. I'm assuming you probably have those people since you have a lot of high net worth folks and family offices. How are you approaching that portfolio, that type of investor, I guess, in comparison to, what about Ray Dalio's fund?
Yeah, I think we're taking an approach that's very analogous, which is, to look at what the investor's portfolio currently has, and to then construct an asset allocation strategy that's going to fit their needs. So, a lot of times we'll get investors that are very much the opposite of your group, which is, they've got exposure in primarily equities and fixed income. And for those individuals, we help design a portfolio that includes some allocation to alternative assets to give them the nice thing about increasing your exposure to your alternative assets when you're starting from just an equities and bonds type of portfolio is you can actually increase expected return while decreasing risk at the same time. And if you do it right, you can get a win-win situation there. And so that's definitely an approach that we take. And then, there are investors, obviously, that we've been in touch that have come out of your group, which are just the opposite, which is that they have tremendous exposure to alternative assets and perhaps are very, very heavy on a particular asset class, such as real estate. And we're working with them to design allocation into some of the more liquid public markets on the equity side, fixed income side. There's credit strategies that are really perfect for this kind of environment today. So we're definitely giving them exposure to some additional alternative asset classes as well.
What do you mean credit strategies? What's that?
Credit is similar to a fixed income strategy. Except they're not publicly traded bonds. They are privately managed portfolios of typically loans. And so you have a lot of protection there from the work that the fund manager does on structuring those portfolios. So you'll get a cash component similar to like a bond. And then you get your return of capital at the end. So those are right now attractive because a lot of these credit strategies are being extended to corporates, which are currently facing high costs of borrowing, right? Whether they go out to the bond markets or whether they go to a private lender like a credit fund, the returns are pretty attractive for investors that are on the other side of that.
Right, and then those are generally high quality companies, so it's pretty high level, good credit. Interesting stuff. So I guess I think that's probably a good place to stop. And I would just say, this is it's been an interesting talk. This is stuff that we don't in our group generally, or I don't certainly talk that much about because I don't, I'm generally focused so heavily on alts. But I do think that, people should, kind of look at different things in terms of trying to balance out their portfolios. I think I'm just starting to kind of think about doing that myself. For years and years, I've been primarily, almost 100% alts, and that's worked for me well. But it's also at some point when you start thinking about, diversity and trying to stay away from volatility like we've had in real estate and stuff like that, there is a lot of value in that. I know you've been talking to a lot of our investors. So through the broker dealer, of course, you've got Valerity Group, and also through your RIA, right? Registered Investment Advisor.
That's right.
That's Valerity Wealth, right?
Yep.
How do people get a hold of you? And how does the consultation work and all that stuff?
Yeah, the good thing is I think a lot of your investor base already knows me, so they have my email. They can contact me, but I'm also if you want to email me on the RIA related stuff, it's Zulfe ZULFE at valeritywealth.com. So that comes directly to me, and of course you can always get a hold of me through Buck as well. So I think there's some really good, conversations we've had with some of your investor group already, Buck, and we're happy to have those conversations. Even just go through some high level stuff. Doesn't cost anything. We get to know you better, and also hopefully give you a little bit of pointers to get going on it.
Fantastic. Well, Zulfe, thanks so much for your time, and we'll have you back, I'm sure, in the near future.
Great to be here. Thanks, Buck.
We'll be right back. Welcome back to the show. Hope you enjoyed it. Again, if you want to have a conversation with Zulfe about potentially balancing your portfolio or coming up with more of a strategy, your overall strategy, get in touch with him. I think his website is also valeritywealth.com, and that's VELERITY wealth.com. I don't think it's a bad idea to have somebody to help quarterback these kinds of things, especially when they're super high level. Listen, this is not a guy who did a 3-month course in, being a financial advisor. This is a guy who's kind of lived it in his institutional mindset and that kind of thing. So there's some real value to be gained by having that kind of advisor, which, candidly, I'm using him myself for things to start thinking outside of the box a little bit more for me. I feel like actually I should say that he's helping me think inside the box a little bit more, because most of the time I'm thinking outside the box. But But yeah, it's a good idea to sometimes think inside the box a little bit and have somebody challenge you who you actually respect. And so that's been really good for me. Anyway, that's it for me this week. Wealth Formula Podcast. This is Buck Joffrey signing off.
Thank you for listening to the Wealth Formula Podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions, not fact. As always, consult your own financial team before making any investment. See you next time.